Welcome to Business Weekly. The price of gold has fallen recently to its lowest level in 2 years. Discussion that Cyprus could sell much of its reserves was one factor that spooked investors. What if other weak Eurozone economies followed the island's lead and sold their bullions? At the same time, the latest figures on the new cars registrations in Europe show the industry's problems are spreading, while the IMF has warned that for the Eurozone, things won't get better anytime soon. We'll discuss all that with Neira Cehic from Bloomberg in the program. First, let's have a look at what's been happening to gold prices.
A stampede out of gold saw it plunge to its weakest in 2 years. One reason given, investors fear central banks like Cyprus and maybe other weak Eurozone economies could sell some of their reserves, with perhaps larger countries in the region also cashing in on huge rises over the last decade. This year it's down $300. The sell-off took it well below $1,400 an ounce, though by Friday the 19th, buyers had started to filter back into the market. As inflation fears have diminished, investors have been cutting back on their gold exposure. Analysts say it arguably was in line for a correction, the price having risen for 12 straight years.
There are worries that some Eurozone troubled countries may be forced to sell part of their gold reserves. Neira, what would that mean?
Alexandra, the price of gold has recently fallen the most in 3 decades. That's a historic collapse. Now, one of the reasons given for that drop in price, and Goldman Sachs in particular mentioned this in a report, was that investors were afraid other European governments would have to follow Cyprus and sell off part of their gold reserves. Now, the US and Germany, so the world's biggest economy and Europe's largest economy, they're the ones that hold the most gold. Central banks in general own about 19% of all gold ever mined, and last year boosted their holdings by the most since 1964. So why do they hold so much? Well, US Congressman Ron Paul asked Federal Reserve Chairman Ben Bernanke that precise question relating to the US, of course, and Bernanke said, very simply, tradition. Does that mean there's no good reason? Why not just sell it off? Well, there is actually a very good reason why the US and Germany, and indeed other countries, wouldn't want to trade in some of their gold reserves for dollars or euros. It's that they would instantly drive down the price dramatically. Think about it. If the prospect of Cyprus selling gold could panic the markets, imagine the result if the US or Germany started dumping even a small part of their gold. As for other countries, holding less gold could leave them more exposed to currency weakness. Some say gold's the best hedge against inflation and currency debasement. And you know, Sri Lanka's central bank governor actually said falling prices are an opportunity for nations to raise their gold reserves, and that his country at least will favourably examine buying more.
Car sales in Europe are in their worst shape for almost 20 years. March figures from the European Automakers Association took many by surprise as demand fell even in Germany. While sales in the US seem to have rebounded, the European market is getting more and more depressed.
European car sales continue to tumble, and the problem is spreading from southern countries to the more prosperous north. For the whole region, registrations dropped to just over 1.33 million vehicles last month from 1.5 million a year earlier. A 10% decline in the first 3 months of the year has manufacturers trimming their sales outlooks for this year and preparing the ground for possible profit warnings. Most worrying, previously solid German sales fell 17% in March and 13% in the first quarter. Comparing the same month over a 5-year period, we see sales were still weak from the economic crisis in 2009, picked up in 2010 and have been sliding ever since. March 2013 saw them down by 10.2% from a year earlier. PSA, Peugeot, Citroën, Toyota and Ford were the worst performers, down around 16% from a year earlier, but even Volkswagen posted a 15% year-on-year decline for its main brand. Britain was a rare bright spot with an almost 6% acceleration in sales in March, but the introduction of the newest number plate artificially boosted showroom traffic. And there is evidence that car makers are having to offer big discounts to get sales, which will hit their profits.
2012 was a bad year for car makers in Europe, with plants closures in the UK, France and Germany, and as a consequence, thousands of layoffs. Is that going to continue in 2013, Neira?
It was indeed a bad year, and you know what? The latest figures for this year were really not encouraging either. European car sales dropped 10% in March. That's put the industry on pace for the fewest annual deliveries in 20 years. Peugeot, Ford and Volkswagen were among the companies with declines in sales last month, and 4 of Europe's 5 biggest car markets shrank, with the steepest drop in Germany at 17%. Car sales have now declined for an 18th consecutive month. Now, Fiat CEO Sergio Marchionne said at the company's annual meeting on April 9th that the market's getting worse day by day, and for the first time, I can't see the bottom. Pretty strong words there. And to answer your question, it doesn't look like things will get better. Full-year car sales across Europe may fall as much as 7%. That's according to Ernst & Young's Global Automotive Centre. And with the market in decline, there are more job cuts and factory shutdowns planned in Europe, at Ford and Peugeot, for example.
The Eurozone economy will not recover this year, so says the International Monetary Fund in its latest World Outlook. Even though the IMF tried to stay cautiously optimistic, the report reflects a significant deterioration almost everywhere.
The International Monetary Fund has trimmed its projections for global economic growth for this year and next. It says that's to take into account sharp government spending cuts in the United States and Europe's struggles with recession. The IMF's chief economist says advanced economies face a bumpy road.
We have moved from a 2-speed recovery to a 3-speed recovery. Emerging market and developing economies are still going strong, but in advanced economies, there appears to be a growing bifurcation between the United States on the one hand and the euro area on the other.
The US gets the best outlook. Japan's predictions were much stronger than in January, while the growth forecasts for the Eurozone were cut, with a deeper recession this year than previously seen. The IMF warned Europe not to relax efforts to combat its debt crisis, given Cyprus's messy bailout and the political stalemate in Italy. It also suggested a Eurozone interest rate cut would help.
The IMF said that from the 2-speed recovery we moved to 3 speeds. How did that happen?
One word, Alexandra: Europe. The IMF cut its global growth forecast for this year, saying the global economy will expand 3.3% instead of an earlier forecast of 3.5%. The report describes, as you say, a 3-speed recovery. That's led by emerging markets, including China. The US is forging ahead. Although its growth projection was reduced to 1.9% from 2%, at least it's growing. The Eurozone, on the other hand, will contract 0.3%. That leaves Europe trailing in the lowest gear of this 3-speed recovery. And the IMF's chief economist, Olivier Blanchard, said the main challenge is still very much in Europe. He said the slump in Europe is worrisome, that the region's still not in great shape, and that Europe should do everything it can to strengthen private demand. What that means is aggressive monetary policy. And as central banks in the US and Japan use unconventional policies such as asset purchases to rouse demand, pressure is indeed mounting on the European Central Bank to do more.
That was Neera Cehic from Bloomberg. Thank you, Neera. That's all for now. Looking ahead, Apple posts its first quarter results on Tuesday, Boeing on Wednesday. On Thursday, we'll learn ExxonMobil's latest earnings, while the UK economic growth data will be revealed. The following day, US GDP growth for the first quarter is announced. Thank you for watching, and see you next week.